Hi, in this video I'm going to look at hedge funds and shorting. And I know that they're both things that a lot of people are quite negative about, but in this video I'm going to look at why they can actually be positive things for investors and for markets. So let's just quickly look at what we're talking about here. Hedge funds. A hedge fund is basically a high-end investment fund. They often have quite high charges for investors, and they often pursue quite complex investment strategies. And many people argue that hedge funds at least partly caused the stock market crash a few years back. And shorting, it's very simple. You short a share when you place a bet that the share price is going to fall. Whereas most investing, when you buy a share in the hope the share price will go up, that's going long. Betting the price will fall is going short or shorting. Now, you might think, oh my goodness, hedge funds, they're bad, doing all these complex strategies, charging too much, causing financial crises. And shorting, that's bad too. That's ripping off ordinary investors and driving share prices down so that ordinary people end up losing their money. And if you combine the two together, hedge funds and shorting, wow, that sounds really nasty and unpleasant. But sometimes hedge funds that short can do good. Think back to the whole Enron scandal in the early noughties. It was hedge funds who first spotted that dodgy things were going on at Enron. And if the hedge funds hadn't been around looking for shares to short, Enron could have carried on being fraudulent, sucking more investors into the bubble for longer, and more people would have ended up losing money in the end. And we've seen similar examples, not as well publicized, but similar examples of fraudulent companies more recently. Most recent one is a Spanish company called Gowex. Now, Gowex had a business providing Wi-Fi in Spain, and its share price was going up and up and up. It was a great stock market success. And then a small specialist hedge fund called Gotham City Research. This is a hedge fund that just focuses on finding companies to short. Gotham City realized that Gowex was very overvalued. So Gotham City took a short position in Gowex, shorted lots of Gowex shares, and then Gotham City publicized its findings to the markets so that the share price would then fall and Gotham City could make money. And you might say, but that's terrible. Shareholders in Gowex lost out because share prices fell. But the reality was Gowex was basically fraudulent. The CEO of the company had been claiming revenue that was way, way too high. Gowex wasn't doing anything like as well as it made out. Because Gotham City came along, the Gowex fraud collapsed earlier than might otherwise have been the case. So Gotham City did a positive thing. And there have been other examples of hedge funds shorting companies and successfully pointing out not necessarily that a company was fraudulent, but that it was just overvalued. And when you have these specialist hedge funds looking for overvalued companies, you actually get a more efficient market where share prices correspond more closely to the real underlying value of the company. So I guess the next question is, what do the shorters like Gotham City look for when they're looking for companies to short? Well, I think they often focus on the issue of revenue and revenue recognition. Remember, revenue is not the same thing as cash coming into a company's bank account. There's all sorts of accounting differences between revenue and cash, and I explained those in a video a few months ago, why profit and cash are both important. But the crucial point is, a company agrees a contract with XYZ for £2 million. It could recognize all that revenue, say all the revenue has come in the accounts, as soon as the contract is pretty much signed. Or the company can wait longer until more work is done before the revenue shows up in the company's accounts, before that revenue is recognized. And basically, it's prudent for companies to recognize revenue later than earlier. So the short hedge funds often look at that issue to see if a company is a bit dodgy and is overvalued as a result. I mean, in particular, Gotham City with GAWEX, they looked at the revenue per employee figure for the company. And basically, it was implausibly high. Each employee was making far too much money. So what was going on was GAWEX could quite easily boost its revenue figure, inflate that figure, but it couldn't really inflate its headcount. So that was a really important warning sign. Another thing that Gotham City spotted was that GAWEX was using a little known auditor that most people hadn't heard of. So that either means the auditor was in on the fraud, or it just wasn't savvy or experienced enough to spot there was a problem. And finally, you always want to look at cash conversion. So that's looking at cash flow. So that's if you like, the cash profit once you've looked at cash coming in and cash going out. So you need to look at how much of that operating cash flow or free cash flow is then converting through to profit. You're always going to see a discrepancy between cash flow and profit, and indeed from cash coming in, you're going to see a discrepancy between cash coming in and revenue. But if that discrepancy is unusually large, and if it's sustained for a long period, that's a warning sign that something is wrong. So I hope I've shown that hedge funds and hedge funds that short shares can be a positive thing. They're not always bad news. And hopefully these are issues that you can keep an eye on if you're analyzing a company and you're wondering, gosh, is it really overvalued? Perhaps this company's a bit overvalued because they may be playing a bit fast and loose with some of the accounting rules. I'll be back with another video soon. Until then, good luck with your investing.